current situation continues in the economy, the worse the debt problem will become on current trends. And so, right. So you're basically storing up more and more water behind the dam.
Yeah, absolutely. And
all of those debt metrics, all of them that the Altman piece talks about, the debt is bigger now than it was last summer.
And that's actually a really good point, because one of the ways we can provide continuity between the two pieces is to maybe acknowledge one or more of those updates. I'll have to go back and see exactly which metrics we referenced.
Okay, and we could probably get a new reading on most of them without a whole lot of trouble.
Okay. I will definitely go pull that.
I wouldn't want to have to go get all of them, because that would take a while.
Sure, and since it's not the core of this piece, it's nice to provide some kind of an update, but we don't have to sort of rehash the whole thing.
Right.
But in terms of the body of this piece, there's sort of two main sections. The first one is to talk about, we've been referring to them as markers, at least in notes. I don't know if that's necessarily something you always say at Credit Risk Monitor, if it's just something that's come up in this article. But talking about the markers that supply management executives should look for when they're trying to root out insolvency risk in their suppliers. And so, ideally,
markers is fine. Sorry to interrupt, but I just want to, before we move on.
No, that's fine.
The word I typically use is signals, as opposed to markers, but markers is fine. It means the same thing in many contexts.
Okay. So do you have, and full disclosure, I had told Linda, and she was good enough to switch out the number for what I have here. The method to my madness around writing, I'm recording. I'm not going to do anything with this audio except work on the article. I promise it's not going to appear on YouTube or something like that. But I am recording just because it improves my ability to think and take notes while we talk.
I get it. I understood ahead of time I was being recorded. Yep.
Awesome. When you talk about whether you use the term signals or markers, do you have a standard list of, let's say, go-to signals that you recommend people look at when they're trying, especially from kind of an early stage, so not necessarily super mature in the area of monitoring the insolvency risk of their suppliers, but just starting to figure out where they stand relative to that kind of risk in their supply chain? Are there a set of signals that you suggest people use as a starting point to look into?
Well, sure, I could tick through some things people could use as markers or signals. So where I would start that list is, where it's easiest, assuming you're not subscribing to a service like ours. Obviously, the easiest thing to do is to just look at the frisk score, but you don't get that unless you're a customer. But if you're not, the first thing I would look for is a bond agency rating. So, for example, if you look up the company and, on, say, Moody's, and you see that they're investment grade rated bond, you're probably done.
Okay.
It's very unlikely that that you're going to have a failure of an investment grade rated company, in the near term. Over the long term, it can happen. I have to say, growing up, I never imagined it was ever going to be possible General Motors would fail.
Yeah.
But they did. But the bond agencies did change the rating between the time GM was a AA rated company and when they failed. I mean, they went all the way down through the rankings. So usually when you're talking about a public company or a big enough company, the public debt or public equity that's going to be rated, that's, first indication is, are they investment grade or not? Triple B or above, or BAA or above if you're talking about the Moody's scale. Now when we get into a little nuance, and I don't know how much you want to stuff this into the article, but I'm just giving you background. So
sure.
Here we go. It turns out that a AA or a BA, same thing more or less, rated company is not that bad. They're junk, but they're good junk.
Okay.
So, unless we're in a really rough economic patch, like it's, the middle of 2009 or something, you're really not going to have a lot of trouble from your BB or BA. Again, same thing.
Okay.
Double B is S&P and Fitch, and BA is Moody's scale.
Okay.
Slightly different nomenclature.
Okay.
Most people use the Moody's, or rather the S&P Fitch type rating scales when we talk about these things. So you could just stick to that and not do the Moody's rating.
Okay.
But, if you have the double B is pretty good. Not investment grade, but it's pretty good. However, there's a huge difference between a double B rated and a single B rated company. Single B is risky. No doubt about it. And there are a lot of single B rated firms among those that are rated. And then more rare, but even worse, you get into the triple C or double C. And those companies are extremely risky.
Okay.
Something like 30% of those companies are going to fail within a year or two. So again, the easiest, fastest thing to do, again, if you're not subscribing to something like Credit Risk Monitor, and you're interested in a major firm that's rated, is to go check the rating. And so you can sleep at night if they're investment grade. If they're double B,
okay.
It's not so bad, but below double B, you need to pay attention.
Okay.
And the next thing I would do, again, and by the way, our first score takes that into account, those ratings into account. The next thing I would look at is if they are a publicly listed company.
Yeah.
I would look at what's going on with their market capitalization, with their stock price. Now, this is a little more sophisticated thing to do than it sounds, but I'll try to simplify it. If you see a long-term trend of rising market capitalization, market value, then it's unlikely the company is going to be in trouble. Especially if that rise is steady.
Okay.
Not volatile, not bouncing around. And the thing about volatility is it means that there are buyers and sellers of the company stock that really disagree with each other. That's how a trade gets made. I think it's going up, you think it's going down, I buy your stock. If you didn't think it was going down, you wouldn't sell me the stock. Right?
Right.
So there has to be a difference of opinion for the stock to trade. And if those differences of opinion express themselves in a stock price that is moving a lot over a relatively short period of time, that is not a good thing.
Okay.
Now, it's especially not a good thing if the stock price is going down. That sounds pretty obvious, but it turns out this is an asymmetric phenomenon. So if the stock price falls by 25%, that would be a red flag. And I'm talking over a period of a few months. That would be a red flag. If it goes up by 25% over the same kind of a period, that's not unequivocally a good thing. It's not bad news. It's not bad news, but it's nowhere near as strong a signal as if the stock is going down quickly. And you might ask me, why? And I would say, I don't know, but that's what the statistical analysis shows.
Okay.
Good reason.
Right?
Yeah.
Now, the other thing you would look at with respect to the market value of a company, and here we're getting a little bit away from stock price and really looking at market value, which, roughly speaking, is the number of shares times the stock price. That's what market value is.
Mm-hmm.
And what you want to do is you want to compare that to the total liabilities of the company. And what you're hoping to see is that the market value is substantially above the value of total liability.
Right.
That's not to say a company can't survive with a market value that is less than the value of its liability. Because obviously any kind of market value, any kind of value to the stockholders must and does already take the liabilities into account. Right? I mean, the market value is, in effect, what's left over after the other liabilities get paid off.
Right.
In the final analysis. But typically you want to see a premium. You want to see a company running with some cushion of market value above liabilities. But a ratio below 1-to-1 is beginning to be a worrying sign, and when it gets to be a small fraction, you're in trouble.
Okay.
Because, and here's the essence of what we call the Merton model. I will digress for a moment. Bob Merton was a professor at the Wharton School. He moved to MIT, and then he moved on into some other things. I think he's now emeritus at MIT, but I'm not exactly sure. Anyway, he won the Nobel Prize, and in no small part for the work he did on quantitative finance. And one of those things that he did was he put together this reinterpretation, I guess, of the theory of how you would value a company's stock options. Now, it sounds like I'm way afield, and I am for a moment, but I promise I'll bring it back. Just 2 more paragraphs.
Sure.
So here we go. The value of a stock option depends on a number of things like interest rates and things like that, but mostly it depends on, whether the stock is going to be in the future worth more than the strike price of the option.
Okay.
Right? So if the strike price is $10 and the stock is going to be worth more than $10 while the option's still active, then I've got an option that's worth something. Right?
Yep.
Because I could pay my $10 and then I can get the stock and I can sell the stock and I got to, right? That's the arbitrage.
Yep.
So here's what happens when the company goes bankrupt. The value of the option is 0. Now, 2 of Professor Merton's colleagues, a guy by the name of Fisher Black, and I forget Mr. Scholl's first name, but anyway, Mr. Scholl's, came up with this formula called Black-Scholes and it was the first formula ever developed to allow people to actually price an option.
Okay.
Before then, it was all guesswork, but then we could actually build a mathematical model to price an option. Now, what Merton realized was that if you can price the option, you can put $1 of value on the option, you can turn that math upside down, and you can set the value of the option to 0, and you can figure out what the probability of that is.
Okay.
And that's the probability that the company will be bankrupt in that same
Okay.
Have I brought it home for you? Right?
Yes. Yeah.
So instead of saying, well, what's the let's use probabilities to determine what the option is worth. Let's say we know the value is 0. Okay, what do the probabilities have to be?
Okay.
Now the most important moving part in that model is the volatility of the stock, which we've already talked about, how much the price is bouncing around. And because obviously if it bounces around more, you have a wider range of possibilities of outcomes in the future, or that's your expectation. And then the second thing is this ratio of market value to total liabilities, because obviously, again, if that market value sinks low enough, the company owes more than it's worth and it's bankrupt.
Right.
So that ratio is pretty critical in our Merton model we use in CRISP.
Okay.
So probably more background than you needed, but it will probably come into handy.
That's okay, though. I'll take
in the future. So back to market value, and it's a pretty simple thing to do. You look at the market value, you look at the total liabilities of the most recent balance sheet, you say, this company looks like the market thinks it's worth a lot more than it owes. It's probably okay. Or not. So, other markers, moving along. We've done the stock price stuff. The third thing I would look at is the other financial ratios. Some of the most popular ones have been used ever since the 70s when Professor Altman developed his Z-score, Altman Z-score. And those ratios are things like EBIT over total assets, equity over total liabilities, and then two more total assets ratios, so working capital over total assets and retained earnings over total assets.
Yeah.
And so, you can look at those sorts of ratios and, without getting into, rules of thumb here, those are some pretty good ratios to look at.
Okay.
I think, in addition, really looking at the trend in any of those things, the trend in EBIT or cash flow. I like to look at free cash flow, which takes into account capital expenditures and depreciation. Obviously, the trend in equity, the trend in working capital, the trend in retained earnings. They tend similar things, but looking at the array of them gives you a fuller picture. We look at some other ratios as well, but I don't think you need to go there.
Okay.
But those are some. Market value is sort of a stock ratio. It's not going to be found anywhere on a balance sheet. But these others are basically, except for cash flow, these are all off the balance sheet.
Okay.
Cash flow takes into account the EBIT takes into account the income statement.
Okay.
So, and likewise, free cash flow is kind of a blend of P&L and balance sheet.
Okay.
Other things we look at would be things like the ratio we call times interest earned. Basically, you're looking at how much, how well you can cover your interest payments with your cash flow. You don't want to see low ratios of that. 6 and above or better. You get down around 1 or 2, and you can barely make your interest payments. That's a bad thing.
Yeah.
Especially if you're highly indebted. I would say, in summary, what you want to do is you want to look at both the income statement and the balance sheet Because a company with a great balance sheet has the ability typically to withstand an extended period of bad earnings results, bad cash flow even. A company with a weak balance sheet cannot. At the same time, a company with a weak balance sheet with a really strong P&L is not in any trouble. There's no reason to go bankrupt if you've got a lot of cash coming in. You pay your bills and you go on about your business, even though you might owe more than you own. Your liabilities might be more than your assets. You might be completely upside down, but as long as you've got that cash flow, you can keep going. Unless, of course, you come up against a funding event, which is kind of yet another consideration, and that is, is there anything on the balance sheet, anything on the liabilities section of the balance sheet specifically that, pops up as a red flag, like, oh my God, we have to roll over $1 billion worth of bonds, in 6 months. Are we going to be able to do that or not, kind of thing, right? So you look at what's called a refunding risk when they have a lot of debt and that they're going to need to roll over.
Okay.
Other kinds of red flags, if I may.
Yeah, sure.
You're looking at the news. Some companies put out a lot of news releases, others not so much. But obviously, if it's a public company, they have to report certain kinds of events. And sometimes private companies will also report certain kinds of events. But, if there's an unusual amount of turnover in senior levels of governance, so you've got a couple of directors resigning, you've got a CFO or a president or a CEO resigning, always worth another look. Usually it's not a bad news item, but it could be. And obviously, if you match that up with the other stuff we've talked about, you've got a company in financial difficulty on their balance sheet and income statement, and suddenly you see 2 directors resign, the rats are leaving the ship.
Oh, yeah.
So you do see patterns like that occasionally. You want to look for any kind of indication in the news of financial shenanigans. Most announcements that the company is restating their financial statements, or the investors shouldn't rely on the financial statements that have already been published. Most of the time that's not terrible news. It's usually a small thing, not a big thing, but they have to make the announcement. But sometimes it is a big thing.
Yeah.
They have to, it's time to pay attention when you hear that, that kind of stuff. And of course, the old joke about the CFO moving to Brazil with his girlfriend, always a bad idea.
Yeah.
And of course, any kind of big liability thing, you get a big environmental crisis or, things like that sometimes tip companies into severe difficulty.
Okay.
You want to be aware of those sorts of bad news items.
Okay.
Too. So I don't think you should leave news out of it. I think even for a private company,
sure.
If it's a big story, they sometimes get swept up, and you can see something about them.
Okay.
Finally, if you happen to be lucky enough, you can either use our crowdsourcing, or you can use something a little bit like it. So basically, for many years, credit managers call each other up and ask, hey, what do you think about this company? And is this guy paying you okay? And sharing that kind of information. Because let's face it, what most of these companies that are reading the article are doing is they're looking at payment behavior. You might want to even lead with this in this flag section. Start with a discussion of what they're probably doing today, which is either with external reporting or even just looking at their own internal accounting, not worrying about people unless they're not paying their bills on time.
Okay.
And so the first problem with that is that they may be paying you on time and not other people. And that's why it's nice to have friends you can talk to.
Okay.
Or an external report. Or if they're a public company, especially a large public company, what we find is that, a company like Kodak pays its bills literally right up to the Friday before they filed for bankruptcy on Monday. They were basically paying on time right up to Friday, because the issue for these giant companies is not, can I pay for that $10,000 copying machine? That's really not an issue. We've got that much cash. Not a problem. The problem is that, $2 billion refinancing that we have to, right?
Yeah.
And that we can't persuade the street to buy. So we're going to file for bankruptcy instead. So for the large public companies, if all you do is look at payment data or use scores that just look at payment data, you're going to get a rose-colored vision of what these big companies are actually looking like. They're all going to look great because they're all paying their bills on time.
Yeah.
But they're not all great. Most of them are great. The good news is in today's economy, 4 out of 5 companies is in pretty good shape.
Okay.
So it's really, the question is, it's the 1 out of 5. And the challenge there is that if you examine everybody in detail, you're going to run out of time because you've got too many people you're doing business with to do all of that work. So the question is, how do you get efficient? How do you focus on the 1 out of 5 that might be a big problem and understand that situation and maybe take steps to protect yourself, to mitigate that risk? That's the challenge.
Okay.
And so if you're just looking at your payment data, you're going to, that's useful. That's going to work for you for a small private company. Because let's face it, for your little company, you're, maybe a company of one person, right? Mm-hmm. So if you get into financial difficulty, the bank's not going to give you a loan at that point, and you're not going to float a bond.
Right.
You're little. So what are you going to do? You're going to pay some of your bills late.
Yeah.
That's all you can do. You just don't have the cash. You can't pay them on time. So that's going to show up in the records that you're not paying some people on time. That's a good indicator of financial stress for a really tiny company. And then it gets to be less and less useful as the companies go from 1 employee to 100 employees to 1,000 employees to 10,000 employees. You get to the 10,000 employee level, payments not that good an indicator.
Yeah.
Because of this, they have access to capital markets. They have other options for day-to-day cash flow that, a small company doesn't have. And small companies don't borrow as much, largely because they can't.
Yeah, no.
You can't get in that much trouble because nobody will lend you the damn money. But if you're Kodak and you wander down to Wall Street, right up to the point where you're really at death's door, they're going to float your billion-dollar bond.
Absolutely.
So, because that's what's there. And so the big companies can borrow the money, and so they do.
Okay.
And sometimes, not always, but sometimes it gets them into trouble.
Okay.
Because they don't, nobody can anticipate the future perfectly. So this crowdsourcing thing that we do is a little bit like watching what, a couple thousand of your really good friends are doing, if you could. with respect to how do they feel about a company. So we look at the activity of our users on the website, and our users are this fantastic group of people. They're the best credit managers at the biggest companies, and they're very savvy people. They've got lots of other sources of information. They can talk to their sales force. They can talk to other credit managers. They've got all these non-public sources of information that they can rely on, plus all the public sources. And so they behave differently. When they look at, IBM, they look at the first page of our report on IBM. It says, investment grade company. Everything looks good. Done. Next. And then they're on to the next company.
Yeah.
Because they don't have time. They're just going to move on. If, on the other hand, it's a company that they're worried about for their own reasons, or if we're telling them the company is somebody they should worry about, they are apt to look at lots of the nooks and crannies in our report. They're going to look at all the news. They're going to look at a bunch of financial statement pages. They're going to look at other information that we have on the website, payment behavior and everything else. And and when they do that as a group, it lights up this credit manager activity score that we have, and we actually incorporate that into our FRISK score as one of the indicators that a company is in more trouble than we might have thought. And so, obviously, that's not something one of the readers can do on his own. That takes a lot of sophistication, and it takes, inside access to our data.
Okay.
But the next best thing to do is to, if you suspect trouble, or if it's a really big exposure, and you just have to be sure because it's such a big exposure,
mm-hmm.
Get on the phone, talk to people.
Okay.
And that includes talking to the company in question because, you probably, if you're doing business with somebody and it's big enough to matter to you, it's probably big enough to matter to them.
That's right.
If you have concerns or questions, maybe about whether they're going to be able to deliver what they've promised on the supply side, or if it's a customer, whether or not they're going to pay you. If you have concerns about that, and people understand, and they'll talk to you.
Yeah. So I think then, and this is fantastic, so I have tons of notes in addition to my recording, so this should hopefully make quick work of our assignment here. Okay. I think the piece that maybe if you have thoughts about it, which would be, and I've written down the pieces around crowdsourcing. I actually think that's great for this specific audience. The majority of them are going to be more focused on their suppliers than their customers, and that's right in line with all of the other procurement discussion right now, or supply chain discussion around opening dialogue, being more collaborative, increasing transparency, right? Getting the flow of information, absolutely picking up the phone and calling those suppliers, right? To get their viewpoint. Once you start to see some of these worrisome signals, getting in touch with them to ask questions.
So it occurs to me there's one thing I've left out of this discussion that you might or might not want to bind in, and that is what we're working on now. And what we're working on now is that there's been a huge breakthrough, as I'm sure you've read in all the papers, in artificial intelligence.
Yes.
And we now have almost a democratized ability to do, among other things, a kind of artificial intelligence called deep neural networks.
Okay.
These are self-learning techniques where the computer figures out for itself what it should be looking at and how much and to what degree. And without getting too deep into a discussion of how neural networks work, which I could do for you if you'd like, but I think maybe we've taken enough of your time already. Suffice to say that this is technology that, probably is known to people through, what IBM did with the Watson system that was previously introduced on Jeopardy. And, it beat human beings at Jeopardy, which seems sort of impossible, but they did it. And another application, which has been fairly well publicized recently, is the Google team that built a program to play the Chinese board game Go. Called Go. And it beat one of the world's leading masters at the game of Go, which nobody ever thought a computer could do. And so what these deep neural networks can do is pretty impressive. And so we, next week actually, are going to launch our first neural network-driven credit score. And it's called the PACE score, PAYCE. And it's aimed at companies where we don't have financial statements. We can't use our FRISC score. These are typically private companies.
Perfect.
And if we have enough of what we call trade data, which is information we collect mostly from our customers, but also from some other companies. And these are records of how those companies are being paid by all of their customers. So we take these accounts receivable files from our customers about their customers, and we invert them so that the data is no longer about how, my customer ABC Corp is being paid. The file, collectively, all the files mushed together are about each of the individual companies that were doing business with ABC and also with other of Credit Risk Monitor's customers that are submitting these files. Hang on, that's my cell phone going off. And I've got to leave Jerry a message because I'm going to finish with you first, but then I'll come back.
And the PACE score is part of what you're offering for subscribers, not a separate product.
It's actually, we're going to, the expression we use, we're going to put it into the sauce. It's going to be part of our fundamental service. It's going to be included. And so the PACE score is going to cover initially about 80,000 U.S. businesses.
Wow.
And it's not as accurate a score as the FRISC score, 96% accurate.
Sure. But you have a lot less information.
We have a lot less information, and it's 75% accurate, which is pretty darn good, actually.
Yeah.
And it's actually better than most of the, or really any of the payment-oriented scores we've seen out there so far, to the extent that we can evaluate them anyway. So we're very excited about this coming out next week, and your article is not going to hit the street until after we've done our launch announcement.
Right.
So I don't know how you want to approach this, or if you want to approach this, or if this is a separate task. But one of the things that's sort of up and coming and new is that while human beings are pretty good at figuring out which way to jump, it turns out that some of these scoring systems are better. And with artificial intelligence, better still. And so we expect to see more and more AI used with a variety of signals, not just payment data, which is what the PACE is mainly based on. It also includes, PACE also takes into account federal tax liens, tax liens, not state tax liens, but federal tax liens. But there aren't that many federal tax liens. It's mostly about payments. And so, but the point is, more AI is in our future, more artificial intelligence.
And that's the perfect place to go because we were hoping to get a forward-looking perspective.
Exactly. I was just going to say that.
This
is what's on the horizon.
I know. It doesn't get more horizon than AI. So that's absolutely perfect.
Okay.
That would be great. And then you know what we can do? I'm hoping, actually, that might be great. I know we're going to be announcing this. I'm working on the release, too, for this, Bill. But if we can, when we write this article, if we can have links going to this in the piece.
Sure.
That would be great.
Do you know what the rules are, Linda, around what we're allowed to say in the piece about Credit Risk Monitor products versus just talking about, looking at market valuation and things like that? Do you know if we're allowed to do that?
They don't want you to be selling, but they do. But they want you to be explaining and educating. So I think the Frisk score speaks to the education part, and what it is. We're not saying it's the best ever and it's the greatest this.
Right.
We're saying it's a score that that it's 96% effective at predicting bankruptcy risk over a year. But and I think the new PACE scores feeds right into the on the horizon. This is what Credit Risk Monitor recently came out with. This additional. Bill, are we calling it an additional feature? Is it additional function? How do you describe it? Additional score?
I would just say an additional score.
Okay.
Yeah, I think that is enough to categorize it.
Okay.
Because of the top companies in this industry, all but one are private. So I think this is going to be of great interest to the readers of this piece.
Yeah, that's right. That's right. Yeah, we were trying to get Bill. We were trying to get score data on companies, logistics companies, and even third-party providers. It's tough because they are private. What's not private are the food companies. Yeah, so at least we have the food companies that Brian gave.
Right.
Which are great. Yeah.
I understand.
Terrific.
And what's going to be really interesting is to see how this performs because, Bill, remember, Inbound Logistics was one of the top, I think it was like one of the top 50 referring sites.
Yep.
When the first article came out. So this is Food Logistics, who he competes with on some level. So it'll be interesting to see how this resonates or how this audience resonates.
Now, Linda, it's not really nice to raise the bar that high for Kelly.
Kelly wrote the first one. She's raising the bar on herself.
It may not be nice, but it's what we're here to do.
Right. And Kelly is Bill. Kelly's been you're like a one of those wonderful, credible thought leaders that's been out there, and she's an excellent writer, but she's also very much involved in procurement and is also closely related to Phil Ideson. Am I saying his name right, Kelly? The procurement or the art of procurement, Ideson.
Yep.
Which is a podcast that gets a lot of traction. And in fact, I'm working with Phil. He asked me, he's very sensitive to any kind of promotion. So I think, Phil, if anybody goes on the show, it's going to be you. So I think he would be, we've got to package it for him the right way, though. So actually, this might help. Kelly, maybe you could help with this, too, or is that a conflict of interest?
Well, I mean, I think it's one of those things. I don't even think Phil's mother could get him to do something that smacked his promotion. So, but being able to make the case the right way, right? You said packaging it. I mean, from a procurement perspective, this existing challenge of vetting and monitoring private companies is actually hindering our ability to bring in smaller, privately held, but innovative suppliers. So it's a huge hot button topic. So if you can find a way to discuss it that stays away from the promotion, there's no question the topic itself is of interest, and it's very current.
Okay. So more to come.
Absolutely.
We'll wait until at least your cold has gone away.
Okay.
All right. Anything else, Kelly?
I don't think so. I just wanted to say thank you, Bill. I know you're going back to give Jerry a call. Tell him we said hi. And thank you very much for taking all this time. Next steps, I'm going to pull my notes and the recording I will put together a first draft of the article, and then I will send that through Linda so that you guys can take a look and review and give feedback, but so that we can keep moving it forward towards the submission deadline. And by then, the other piece will be up, and we can embed the link to it. There's no question they would allow that.
Yeah.
Terrific.
Okay, excellent. All right, Kelly, thank you so much. Bill, thank
you. Thank you both so much.
Well, thank you.
Have a good afternoon.
All right, you too. Bye.
Bye-bye.